As long-term investors, the market sometimes gives us a wonderful gift. Equity markets sell off and suddenly we find ourselves with an incredible bargain. But the question is, when do we know when shares are actually cheap? So in this video, we're going to look at valuation and how you can come up with your own estimate of when the S&P is reasonably priced. Now, I'm not going to make any kind of predictions in this. That's really up to you. Now, if you want to join our rapidly growing community of people who are trying to educate themselves about markets, why not join our community? It costs just $10 a month, and then you get to join us on Slack, and you also get to join us on our Sunday evening call and see all of our previous Sunday evening calls too. So now let's look at equity valuation in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. This is probably a good time to step back and look at the long-term history of equity. This is the S&P 500 since 1962. And although the recent sell-off seems terrifying, taken in this context, it isn't quite as scary. And that reiterates the central idea for many investors, which is that you should have an asset allocation you're happy with and you should stick with it. Trying to time markets is extremely difficult. But we can ask the question, what is it that drives equity prices? If we understand the drivers of equity prices, then we can use that insight to gauge when equities have fallen enough to be considered cheap. Now, the primary driver of equity growth is the growth of earnings. This is the profit which companies generate. And one thing that US companies are extremely good at is growing their profits. For over a century, they've managed to grow profits at a rate which is about 2% above the rate of inflation. To see what a close relationship there is between earnings growth and equity prices, I've plotted them together on this graph. And you'll see that the price growth rate of the S&P 500 is very similar to earnings. And that's not a coincidence. When you get a period of very strong earnings growth, then you also get strong equity price growth. And during a period of earnings recession, when earnings fall, you also tend to get a fall in equity prices. That immediately suggests that if we look at the price of an index divided by the earnings generated by that index, it should be roughly constant over time. If prices rise too fast, or faster than earnings, then it's probably time for a correction. Of course, there are thousands of drivers of equity prices, but one way many equity strategists look at this is to break it down into just two things. The first one is that price to earnings ratio, which is called the earnings multiple. That's how many dollars you're willing to pay for every dollar of profit generated by a single company or by all the companies in an index. Now, sometimes markets get carried away and they're willing to pay too much for every dollar of earnings. And Robert Shiller famously called this irrational exuberance. Others call it animal spirits. At other times, such as now, investors enter a state of utter despair, and during these periods they tend to underpay for earnings. And when the price paid for every dollar of earnings is falling, that's called a de-rating of equity. Or you could say that the market is re-rating to a lower level. The second factor is not behavioral. It's an actual number which is published every quarter, which is the profit generated by an index. And that's why there's so much focus on quarterly earnings. When those fall, it's as if you've taken away the support for the price of an index. And as a consequence, prices often fall. You can keep track of those earnings on the Yahoo website or using the US company FactSet, which publishes S&P 500 earnings updates every Friday during an earnings season. As an example of this method of pricing equity, here's an S&P 500 forecast from Goldman Sachs. The price of the S&P rose very strongly in 2019. However, earnings didn't, which was one of the reasons I halved my equity allocation. People often talk about consensus earnings. Now, that's the average earnings growth that's forecasted by investment banks and other stockbrokers. Now, usually these forecasts tend to be very optimistic, and 2020 is certainly no exception. Despite the very sharp fall in the equity market, you can see consensus is still forecasting a very rapid increase in the level of earnings. Goldman Sachs, however, is much less optimistic, forecasting a 3% fall in earnings in the first quarter of 2020, then minus 15%, minus 12%, and a final return to growth of plus 12% at the end of 2020. And based on that forecast, they thought that the S&P 500 bull market would soon end. They forecast that the S&P 500's fair value over the next 3 months would be $24.50. So how did they come up with this estimate? Well, firstly, they think that equities are going to re-rate downwards to a multiple of just 14 times forward earnings. And by forward earnings, we're talking about that forecast earnings over the next 12 months, which in the case of Goldman was $175. So the forecast price from Goldman was an earnings multiple of 18.2 times forecast earnings of $175. So for the year end of 2020, they're forecasting the S&P 500 will be back at 3,200. So I'll show you now how to come up with your own estimate of what's fair value for the S&P 500. And we'll start with the forward price to earnings ratio. This is 20 years of history of the forward PE for the S&P 500 from the data provider FactSet. It was at extremely high levels around 2000, which is the dot-com bubble, but then that bubble popped, and then during the global financial crisis, it fell again. And the post-global financial crisis low was 8.5 times forward earnings. Since 2011, you can see that a large proportion of the growth of the S&P 500 has been generated by a re-rating upwards. In other words, people are paying more for every dollar of earnings. There was a little hiccup in 2018, but then the re-rating continued in 2019 and was largely responsible for the rally in equity that year. And then by the beginning of 2020, the S&P had hit this record level for the previous 2 decades of 19 times forward earnings. The average forward PE over the last 20 years has been about 15.5 times. So you can see that that value of 19 was extremely high. Looking at a more recent version of that graph from FactSet, you can see that the equity market has fallen, such that it's now below the 10-year average of the forward PE, which is 15 times. So we can look at the S&P 500 since the beginning of 2019. This is the very strong rally that we had, and then the recent very sharp fall. And the question we're going to try and answer is whether that now represents a cheap valuation based on forward PE. To start, we'll make a very simple assumption, which is that the very optimistic earnings forecasts will remain in place, and that the S&P will generate $177 of earnings over the next 12 months, such that all of the repricing is due to re-rating. So it's a purely behavioral factor which is making investors de-risk their portfolios. Based on that forward earnings forecast, the 10-year average fair value would be $26.58 for the S&P, which is 15 times 177. So let's assume that we get a re-rating down to the level that we saw after the global financial crisis. That would take us down to 8.5 times 177, which would be an S&P level of just over 1500. You can see that currently we're well above that level. So what we can say is that at least so far, equities are nothing like as cheap as they were in 2009, but they are just below fair value based on that 10-year average price to earnings ratio. Next, we'll consider what's going to happen if earnings get downgraded. In other words, the actual profits of companies will fall due to a slowdown in economic activity. What you can see here is the peak to trough fall in earnings over the last century and a half for the S&P 500. The blue bars are periods of recession in the United States. And you can see that when a recession starts, typically the value of earnings falls, and depending on the severity of the recession, sometimes that fall can be very large. So in 1921, earnings fell by 87% from their previous peak. They never really recovered and then fell again in 1932 and 1946. But in fact, the largest earnings recession was in 2009, when earnings fell by 92%. And sometimes earnings fall without a recession at all. That happened in 1987, when earnings fell by 35% as part of a double dip. And it happened in 2016 when there wasn't a recession, but earnings fell relative to their peak by 19%. So let's assume that we get a very conservative 20% fall in earnings. Now you could look at this graph and come up with a completely different estimate. Perhaps you don't think there's going to be a recession at all, or perhaps you think it'll be a depression. But these precedents should help you calibrate your earnings fall. Instead of equity now being cheap at a price of $1,500, reducing the forward earnings by 20% means that they'd now be cheap at a value of the S&P just above 1200. So just to make our assumptions clear, that's assuming a 20% fall in earnings and a re-rating to a level seen after the global financial crisis. So it's a combination of a behavioral pullback in risk appetite and a fundamental fall in the value of earnings. And if that comes to pass, then equities could have much further to fall. Another measure of equity valuation is created by Robert Shiller, and this is called the cyclically adjusted price-to-earnings ratio. Instead of dividing by the forecast earnings, which is, let's be honest, just a guess of what's going to happen, Robert Shiller suggested that we look backwards and average over the previous business cycle of 10 years. So that's the denominator in our price-to-earnings ratio. What's good about that is that it tends to be very smooth, because you're taking that long-term average of earnings. Since the late 19th century, the median value or typical value of the CAPE measure has been 16.3 times cyclically adjusted earnings. Many people have pointed out that interest rates have been close to zero for almost a decade, and when that happens, the discounted cash flows of equity are discounted less, and that pushes up the value of equity, which was their justification for saying that equity should be more expensive. But what I like about this measure is that it's very simple. What's great about the CAPE measure is that it's pointed out bubbles in the past, such as the dot-com bubble, and the bubble just before the Great Depression, and what's increasingly looking like the bubble of 2018 and 2019. In this graph, I show the value of the S&P along the top, so cheap is on the left and expensive is on the right, and along the bottom I've got the equivalent cyclically adjusted price-to-earnings ratio, with cheap on the left at 10 and expensive on the right at 40. What the bars show you is what percentage of the time the S&P has spent at these levels of expensiveness. It's very rare, for example, to be above a CAPE ratio of about 35, and it's also very rare to be below a CAPE ratio of about 10. Now, the times when CAPE is most informative is when it's at these extreme values, either very cheap or very expensive. And if history's a good guide, then when it's been very expensive in the past, the decade returns following that valuation have been very poor, whereas when it's very cheap, the following decade of returns tend to be very good. When the equity market was at its peak in 2020, it was at a 31 times multiple based on CAPE and a value of 3313 for the S&P 500. As I make this video towards the end of March, the value of the S&P is around 2400, which is about here. Now, the typical long-term value of CAPE has been 16.3 times, which is an index value of about 1740. So by this measure as well, with the proviso that interest rates are very low and that tends to push up equity value, a value of 2400 still doesn't look cheap. So for example, following the credit crisis, the CAPE measure fell to a low of 13.3 times earnings, which would be significantly lower, with an index level of about 1400. Now, if you do think we're going to reach Great Depression levels, which personally I think is extremely unlikely, then we go down to a multiple of 5.6 times, which would be an index level below 600. Now, one of the things that's characterized this equity sell-off is its speed, and unfortunately that means we're flying blind in terms of economic data and in terms of earnings data. As we said, corporate earnings only update on a quarterly basis, and we've just had the Q4 earnings season for 2019. We still don't know what the earnings are going to be like for Q1 2020. US GDP is also published on a quarterly basis. There is higher frequency data, so for example the US unemployment data, and in particular non-farm payrolls, is updated monthly, as are the purchasing managers' indices, which are published by Market, all of which I mention frequently in my weekly market update. What we can say is that the US PMI was heading downwards anyway, and that's before we got this very rapid decline in economic activity. But we do have data for China. Now, a PMI level below 50 signals contraction, and what we saw at the beginning of 2020 for China was an absolutely staggering halving of its PMI index. Now, hopefully this will rebound very quickly as economic activity resumes. My worry is that we're going to see a more prolonged impact, which is going to affect corporate earnings in a more significant way. Another thing to watch will be non-farm payrolls in the United States. This is the number of jobs which the US has added to the economy every month. When this is high, it's a good indicator for US economic activity, because if lots of people are employed, that means they can spend money, and corporate earnings growth tends to be strong. But more frequent data, called initial claims, have spiked upwards recently, and that suggests the US may be about to see a rise in unemployment. The data the FT was talking about is called initial claims. Those are new claims for unemployment benefits, and those are filed by people when they're newly unemployed. You can see the spike upwards to 280,000 in this last data point. And if that upward movement is sustained, it's often a signal that we're entering a US recession. Some economists try and predict GDP on a very regular basis in something called a nowcast, where every economic piece of data is incorporated into the new forecast as it appears. However, even this hasn't had time to be updated yet. Here's the one from the New York Fed, and this is the one from the Atlanta Fed, which also hasn't really been revised downwards. If anything, recently it's been trending upwards. But what's great about the Atlanta Fed model is that it publishes a schedule of the data that's fed into the model, so you can see when these data points will occur. And then when they're published, you can see the effect they have on the GDP forecast, either positive or negative. So this might be a nice timely way of keeping track of how high frequency data is going to affect US growth and indirectly the equity market. So why not share what you think is going to happen to the S&P 500 based on your estimates of what happens to earnings, but also whether we're going to get a derating from where we are now or whether equities will re-rate upwards. Just share your view in the comments below. Now, if you want to discuss this with me in more detail, you can always arrange a power hour with me on a one-to-one basis, and you can just go to the website to sign up for that. And I'd love to see you. And as always, thanks for listening.